if you'd have told me that the Fed chair is potentially facing a criminal probe and the Iranian regime may be teetering and about to fall, I'd have expected maybe a bigger response. But we're not getting it. So why aren't we getting it? Let's try and answer that question. Skylar, Montgomery, Koning joining us around the table. Why not?
Yeah, I mean, maybe we tackle the oil price first. And
okay.
I think anytime you have disruption like that, you need to think about what does that country actually produce? How big is that supply? Now, Iran produces more than, say, Venezuela in terms of, I think it's like 3.5 million barrels or something. So it's just over 10% of OPEC. But we're in an environment where there is quite a lot of supply this year. The worry is a supply glut. And if you look at spare capacity elsewhere in OPEC, that can more than make up for it. So I think you have to think about that backdrop, as well as we did have a bit of price pressure at the end of last week. So we're coming from low levels that were pushed up a little bit as these tensions kind of built into the weekend. I think it is a reminder, though, that you need to think about geopolitical risk in terms of how it feeds into commodity markets, that you need to think about these kinds of stagflationary shocks, even if we're not getting them now. And that does mean that you need to think about having kind of real assets in your portfolio. And that's probably why we also have such a strong bid for gold.
Yeah, gold and silver looking pretty real this morning. What about, to Guy's point, what about a lack of reaction, if that's what we're seeing in the Treasury markets? Yes, we've got some reaction at the long end. It's up 3.7 basis points on the 30-year. Is this the scale of response you would expect to see, given what has developed around the Fed?
Yeah, I think it's largely because we've had these threats before, and they've proved non-credible. There's quite a high bar to have a complete disruption of who's on the board. It's well recognized that, we're not going to get a big changeover, and so you're not going to lose that inflation fighting credibility, which is really what markets are concerned about, because the idea behind that inflation mandate is if you're an investor in U.S. assets, you're not going to lose more than 2% in purchasing power per year. And so if that goes away, then you don't want to hold on to U.S. assets. I think last year we had a couple weeks of outflows around Liberation Day in particular, but because the U.S. still has a high yield, because it still has highly profitable companies, there's still this bias to buy U.S. assets. And so it's not really something that you've seen in terms of flows out. It was a hedging story in the U.S. last year, but I think that's why you have such a tepid reaction this time around, because the only thing you're seeing in terms of diversification away from the U.S. is central bank reserves.
So maybe the focus shifts to inflation tomorrow, CPI out of the U.S. Tuesday. What kind of number would derail market bets? 2 additional cuts this year. What kind of print would change that dynamic, or at least change that price?
Yeah, I think it would have to be a pretty high print, because we've had inflation that's well above the Fed's target for a while now. And then there's this bias within the committee to think that the unemployment mandate or the labor market mandate matters more than the inflation mandate. I think what maybe you need to focus on isn't so much one print, because we need a series of prints to get a trend, but this idea that you need to watch every data point, you need to watch every speech, because it's a highly divided board. And so that means you're going to get more volatility, you're going to get pinged around on this comes in, because you're trying to decide not only when the next cut is, but where terminal is, and that's very important.
And we'll have a lot of Fed speakers commenting this week as well.